Welcome back, investor. We got another episode of Passive Income Adventures where we talk about the kind of lifestyle you want to live and we give you tactics on how to invest so that you can actually pay for that lifestyle. If this is your first time here, my name is Emma Powell. My husband and I retired early about 3.5 years ago. I was 46, he was 48, basically from a real estate business that I ran as an entrepreneur. But that whole time that we were building that wealth and that cushion, had that early retirement in mind and were focusing on helping others put capital into our deals. So we were raising capital in private placements, real estate investing for the most part. And we knew that we would eventually have to put our money in privately so that we can have passive income because we don't believe that passive income comes from running a business. It comes from investing in other people's businesses. And so today we've got Whitney Elkins-Hutton with us. She is with passiveinvesting.com, Dan Hanford, and basically in charge of investor education. And we're just going to talk about all things LP. We're going to see where this conversation goes because this is like Whitney and I networking. Well, you get to listen in and hear what two basically retired passive investors are doing with our time, our lifestyle, and helping educate you from people who've actually already done it ourselves. So thanks so much for coming on the show, Whitney.
My pleasure. This is going to be fun.
Yeah, I don't get to talk to very many people who are really diving into the passive investing space as an educator. And I think it's interesting that you're with a bit of a larger organization so that you can really niche down into exactly what it is that you do. So can you tell us a little bit about your background, how you got to this point, and then we can talk about what you're working on right now.
Yeah, definitely. So, currently where I'm at, I'm the director of investor education at passiveinvesting.com. That is not where I started. I did
Yeah.
not go to school for this. So,
House
I,
for this.
I, right. So I kind of fell into real estate. Back in 2002, I purchased a house with a significant other. And after about a month, the relationship fell apart.
Mhm.
I was the money partner. He was, if we're going to talk about partnership,
Yeah.
I brought the money, he brought the skill, and we were gonna, split the profits on this deal, and hopefully actually live in the property long term and then, continue to build. But a month later, relationship falls apart. And I had a house that had green shag carpet, psychedelic daisies from the 1960s painted all over the walls, you name it, walls in the wrong places. So that was my first foray into real estate. I bought the Home Depot 1, 2, 3 book and
Yeah.
we're like, we went to the Home Depot classes, learned how to fortunately, I already knew how to use power tools. My dad did woodworking as a hobby, so, I wasn't terrified of that. Like,
Yeah.
I could destroy things and kinda go, "Ooh, how does this go back together?" Like,
Hmm.
kinda had a little bit of fun with it. But long story short, about 11 months later, I put the property back together and I sold it, which was probably my number one investing mistake. And all this time I've
Yeah.
been renting out rooms to friends who actually would help me do the work. And also I could pay them in sushi and pizza and beer and all that sort of stuff. And I sold the property and they put a $52,000 check in my hand. I'm
Yep.
like, whoa, cool. I was doing all this work on nights and weekends. I was not traveling 80 hours a week like I was for my day job. And I'm like,
Hmm.
wow, this is the first opportunity that I can actually unhook my value in the world from how much time it took to create it.
Yep.
And I did it on my own schedule. And then fast forward a few months when I'm doing my taxes, I finally realized the power of the 121 exclusion, which is kind of like the everyday man's 1031 exchange. And I was like, wait, so I don't have to pay tax on the
That's
30,000 that I
there.
made here and then the 52,000 I made here. You're telling me I don't have to pay tax on it? Like, this is bananas. I was like, how many more of these deals can I do? And that's when I started fix and flipping and limit hacking. Kind of collided the two strategies together.
Yep.
Those names didn't exist back then. Did that for several projects and then started buying rental properties, ready, fire, aim type strategy. So
Mhm.
I scaled to about 40 units before I went, do I really want to be an active investor?
Nope.
Like, nope, do I want to manage the property manager? Kind of over this. So I was like, I'm going to transition. I'm going to buy a multifamily building. So I went and bought a
Because
32
people
unit.
think that's going to be less work and it's not.
Right. No, 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 no. Like, but you think economy of scale.
Yeah.
Well, so I took on partners. We buy this building. Learned just so much in that transaction. Broke
Yes.
even after 2 years. Got out. And I'm like, "Oh, okay, I need to go bigger." So, got into partnership with 2 other amazing women and started helping them scale their private equity firm. And, first raising capital and then as a partner, a minority partner in the business. But all this time, like what you and I were talking about for the show and what you said in the introduction, I'm like, that was all really active work. Yes, I can get bigger payouts, but also I'm in the last position to
Mhm.
get paid.
Yep.
If I hit a challenging market, all the equity that I hope I'm getting can go poof. And I'm like, I need to start investing in somebody else's deals, equity, debt, both at the same
Yep.
time in order to build my own portfolio in case I want to make a change. And so that's what I started doing kind of in the background. I'm multiple scores of deals at this point in time passively. And anyways, long story short, that's what I love teaching people how to do is how to first understand what passive investing is. What are all the nuances? How does this, what transferable skills can they bring in from the stock market
Mhm.
investing to this, but what else do they need to learn? And then how to craft a portfolio that can respond to market volatility. That's another thing that I've really been hammering home the past few years. Everybody wants to be in that beautiful deal that gives them cash flow, equity, and tax benefits. But the reality is, what the last market cycle I felt like taught us is that we can't actually rely for any one single deal to give us all of those wealth levers. So
Yes.
um, that's what I love doing, and that's what I'm passionate about.
Yeah, it's such a great story because I feel like some people can relate and some people are not going to relate. So I feel like it's a great story to show like how active real estate ownership can build wealth. Um, but most of my limited partners don't do real estate, which is odd because you think the people who do real estate would really understand and they're like, "Yeah, this is hard. Let me invest with you passively." Most of the real estate investors I know have not hit the passive point yet. They're still building wealth. They don't have any extra money to invest in somebody else's deal. Even though they understand real estate, they're oftentimes just have the least amount. And they're looking at those higher returns that they get from active management. And they're like, oh, you're only offering me like 16 to 17% IRR. What? Like I can do like 40 on them. Like, yes, you can, but it's a job. And so if they want to get out of the job, you have to start thinking about passive investing. And so being able to educate people about that is important in the real estate space. But also, I find like most of our investors are just highly paid people who aren't going to spend all that because they live, well below their means and they splurge on something every once in a while. But for the most part, they're like, I have extra money and I would need to be more responsible. So I don't have to work this job till I'm 65 years old. And they kind of have that realization that and I don't want to retire early and lose my purpose. We all know we're going to work the rest of our lives. It's just a
Mhm.
matter of finding something that really helps us build our purpose. And so, just as we're talking, to kind of speak to both of those investors, the real estate person, especially the younger people who are listening, they're hustling, they're doing the house hacking. Like everybody should do that. Um, and I feel like that younger person who's gonna do the hustle, who's willing to do the hustle, but always in the back of your mind, you gotta be thinking like, "When am I gonna transition?" And also speaking to just the high income earner who doesn't know anything about real estate, and we're asking them to put 5, 6 figures into real estate deals when they've never even maybe had a rental or they have, like, one that they used to live in and they moved out of. So those 2 avatars I see, the ones who are really seeking a lot of information about how to passively invest because the real estate investor who can't give up control, can't give up the upside, and then the high income person who's like, I don't have time to learn about this, and it's a responsibility. How do you address those two groups of people?
Well, I want to demystify or dispel a myth. Like passive investing is actually not exactly passive. It is
Yeah,
the most passive investing you can do in
yeah,
private equity.
most passive.
Most passive,
You
right?
trademark that.
But so okay, what do I mean? And I mean you as any investor, doesn't matter which avatar, you have to understand your
Mhm,
goals. What do you need? I always have my investors, especially the ones that I coach personally, start with that 10-year vision. What do you want to do? What do you want life to look like in 10 years? And then let's back it up to like what you need to do today to be on track for that 10-year vision.
yeah,
Okay, what's your risk tolerance? Like just because you're willing to jump out of an airplane with a parachute, if you don't have reserves, doesn't mean you actually can jump out of the airplane. That means your risk tolerance and your risk capacity, we have to get those aligned, right? And when we understand that, then we kind of understand what type of investing you can go into. How do you want to use your time too? I mean, my younger self, when I was doing all this active investing, swinging the hammer, painting the walls, well, for one, I had to do that. I was not wealthy. Like, I had to do that. I had to create the sweat equity. But two, I had the energy to do it. My
Yeah.
attention wasn't divided with, I had my job and I had my real estate. That was it. I didn't have a
Mhm.
husband. I didn't have a child. And then as I started building my life, I had to start backing off of what things I could do or take on from time and attention standpoint. And so there's seasons of life. So if we're talking to the investor that is like, hey, I'm late 20s and I can go get a 40% return if I do this. Well, okay, my comment to that is you can get a 40% return and the market can turn on you in that you can get zero
Or negative.
negative.
It's like one of the only investments you could do where you lose more than your investment. Like, if you lose, it could you could lose more. Like, in the stock market, you're rarely gonna lose more than 10% in the stock market. Just easy set it, forget index funds. I mean, it's volatile, but over time, you're rarely gonna drop more than about 10%. If we do, we're like, it's on the news and everybody's freaking out. And it usually recovers. I just haven't seen, like, these huge losses. But in real estate, it's one of those things, it's like you can lose your entire amount of money that you put in, and then you've got this loan that you're on the hook for that you have to have a
Mhm.
foreclosure. And there are ways to get out of it, if but it is a great way to lose more money than you even invested. And so I don't want to scare people off from doing it, but I'm also not going to be one of those people who's like, it's easy, buy my course, watch my YouTube channel because I'm making money off of convincing you that it's easy. Like, that to me is unethical. It's not easy. It
Mm,
but it's worth learning and doing. Um, but and it takes hustle, but it certainly should not be taken on lightly.
no. And we're talking about the active investor. Now,
Mhm.
passive investing, if you're entering a deal as an LP, in theory, you
Yeah.
are capped, right? Like you're not going to lose more than your initial investment unless, you are in a deal that you had to participate in a capital call and then, that goes wrong too and now you've lost your capital call dollars, right?
Mhm.
Okay. But so let's back it up, continue to kind of focus on the two avatars. That the active investor, I believe there's a time and place for it.
Mhm.
Um I would say you know, 9 out of 10 people that I talk to that are interested in either active or passive real estate, only one should actually be doing it. There's only one that's like they're like hungry. They love real estate. They wake up and breathe it, right?
Yes.
That's the person that should be doing it actively.
Yes.
No matter if they're like doing small single family, small multi, or even like raising capital. The other nine, if you're kind of like tire kicking it, expecting it to be like, a really simple, easy business to like operate on nights and weekends, that's generally not the case. You need to be incredibly great at systems, incredibly great at delegating in order to make that happen. But most people aren't. Most
Yep.
people, want to latch down and have, immense control. Now, if we swing the pendulum the other way and we're talking to the investor that is like, hey, I have a higher and better use of my time and attention in my, high income day job or building my own business. Great. Then take some of those skills. You have a lot of skills, for, a business mindset probably already. Let's take those skills, hone them for learning how to evaluate not only your own goals and risk and timeline, but evaluating the operator market and deal. And let's transfer that into what you actually building a portfolio outside of how you're earning your other income. I call it taking chips off the table. No
Yes.
matter what, if you're active or an employee, let's take some of those active chips off the table, that active income off the table, and let's put it in passive deals because at some point in time, whether it's 1 year or 10 years or 20 years, you're going to wake up and really wish you had those streams of income already built for yourself.
Yeah, takes time. I mean, you make a couple of really good points. Passive investing is not passive. The investment is passive. Once you
Mhm.
put money in, you need to monitor it and have conversations. You need to, just for your own keeping track of it, but you have no material effect on that deal. Nobody's going to be asking you to vote on anything or show up. the worst, you said, like, it's a capital call where they want you to put in more money, in which case you could still only lose your total amount of capital. You just had to put more in, but which is a thing. Maybe we should talk a little bit more about like what to expect as a passive partner. Like, what does a capital call look like? What if you choose not to participate? All of that. So we should put a pin in that and come back to it later. But let's talk about the education side, and that's part of the education side. But like the first things that somebody needs to do when they've decided, like, hey, I have a couple of rental houses. I know I don't want to scale this to 40 or 50 that I would actually need to retire onto. So I'm just going to keep my couple of rentals. Maybe they bought their building. Like I know a lot of dentists who will buy the building and then rent out office space. So maybe they have a little bit of exposure to it, but they're like, I'm good. I would like to put some money into somebody else's business. And I'm like, okay, some of it should go into real estate and some of it should not because they feel like they really understand real estate and then they're kind of overexposed in that. I think people take on too much risk when they think they're diversified because they have their dentist building and they had a couple of rental houses and they invested in some multifamily with you. And I'm like, that's not diversification. So when somebody's starting to educate themselves, what are some of the first steps that you're saying? Like, it's not passive education. That part is active. So where would someone even start?
Well, so I mean, you have your YouTube show. I would probably rewind and watch all these episodes. I have mine at passiveinvesting.com, YouTube page, specifically focused on the boot camps. Those are the skill building
Yes.
webinars that I have for everybody. Now, you know, so again, goals, risk timeline, understanding your risk capacity. Let's put together an investor thesis. Okay, I'm breezing through this. These are all individual hours of training, right?
Yes.
But those first few steps are like the core foundation, right? That's the base of everything. You're going to do that once and probably come back and visit it every
Mhm.
year to make sure nothing materially is a change in your investor thesis. All
Mhm.
right. Then we plan for the capital. How are we going to allocate capital? That you're going to, revisit at least on a, annual basis, if not a little bit more often. And then, learning how to evaluate the operator market and, deal specifically, those are skills that can be learned. It is like, a short, like little certificate program, right? Like you're building your
Mhm.
own education certificate program. But once you have those acquired those skills, it's like going to the weight room. Like the first time you list that like 10-pound weight, it's probably feels like 20 or 30, right? Like it's heavy.
Mhm.
I'm actually rehabbing from a shoulder surgery right now, and they put a 1 pound weight in my hand last week.
Yep.
1 pound. No, I'm like, oh my God. I'm like, actually, she put a 2 pound weight in my hand. I'm like, oh yeah, I can do 2 pounds, no problem. And she put and I was like, can I have the 1 pound? But I had to like relearn and reshift my skills, and there was some muscle memory there. I'm like, oh, okay, this is this is how you do it. Press the
Mhm.
scapula and raise the arm, and I'm quickly up, up. That's what we're doing when we're building those skills and moving them from how you're working currently in your job or in your business, and then putting it to into investing. Now, there's a specific exercise I encourage any investor to go through, no matter if you're starting off or more advanced, because I don't necessarily look at my allocation based on asset class. That's part of it. But I like people to look at their allocation based on risk. And
Mhm.
so, take all of your investments, all of your stock investments, all of your, not the individual stocks unless you own individual stocks. We can lump all the stocks together, all the bonds together. And I would give it a risk score 1, 2, 3, very
Okay.
basic. One is like emergency reserves and like immediate liquidity, like
Mhm.
your 6 to 12 months worth of reserves. Where is that sitting? Okay, we're going to give that a risk score of 1, hopefully, right? Like it's
Yeah.
very liquid, very safe, maybe in the bank, maybe some money market accounts, maybe cash flow life insurance, pretty protected.
Yeah.
All right. And then your equity deals, we're going to give them a risk score of 3. Okay. That can be stocks, it can be bonds, it can be your controlled real estate, it can be your private investment. Give that all that a 3. Now, if you have debt, okay, if for my savvy investors, they're like, oh, Whitney's telling us about a capital stack. I am. Then give that a risk score of 2, your different layers. Do you have
Mhm.
senior debt positions? Do you have mezzanine debt positions in your portfolio? Guys, preferred equity is equity that gets a 3. Okay. Now there's the whole scale within each one of these
Yeah.
categories. But look at your portfolio and see where you're most heavily invested. Okay. And the reason why I kind of developed this framework is, you know, most investors is, especially when they, started drinking the Kool-Aid around private equity and real estate, they're like, okay, if I diversify across operator, market, and deal and asset class, I'm taken care of. I got diversification. What do we got there? The exposure around the
Commercial real
capital
estate
stack.
is still a qualification. It's still a category.
Yeah, well, yeah, but
It's all equity.
it's equity, right?
Yeah.
So we have to back it up and be on both sides, like on, above, below the line expense, which would be the equity, and above the
Mhm.
line expense, which would be the debt. So that I would encourage people to look at how their portfolio is crafted that way. And then once you kind of get the breakdown, now we can start looking at the different asset classes within each one of those tiers and really get true diversification, and hopefully craft a portfolio that's going to navigate the next market cycle a little bit better.
Uh, yeah. Well, I mean, we always kind of get caught at the end of a market cycle. I do think it's easier to time the markets with real estate than it like data has shown us in the stock market, like just don't even bother. Like you're gonna like buying the dip. Maybe you can buy the dip. Maybe you can't. I don't know. Real estate, you can't really either because we don't know what's happening, but because it's happening in slow motion in private markets versus public markets, we don't have as frequent evaluations. The liquidity is not there. Panic sell offs are not going to hit in the same magnitude as they do in these are easier to trade liquid assets. I feel like it's a little bit easier to time the market, especially since the assets are so unique. Like this house is not like that house, and this building's not like that building. But I feel like people still try to overdo because we can do it a little bit. They try to do it a lot, and they're sitting on the sidelines while all of this crazy stuff is going on with interest rates and tariffs and whatever else is going on. And then they're just like, I don't know when to buy because they don't know when the bottom is. And I feel like people have been burned a little bit on their real estate, passive real estate over the last 2 to 3 years. What now? Where to go from now? They educated themselves. They did their risk analysis. They did all that stuff. They put the money in, yay, and then maybe they lost some money and now they're psychologically trying to recover from that. What does that look like?
Mhm. Well, on a couple different, suggestions I would make to that particular investor. Like one, do that risk tier evaluation because, I've worked with a lot of investors privately that did that risk tier and they're like, oh, I had 4 months of risk and then I had I had my house over my head and then I had like 94% private equity deal.
Yep.
So it's eye opening. If they were relying on cash flow to pay their day-to-day expense, they didn't have any stable, boring investments like notes, like debt, like,
Uh-huh.
I don't know, a dividend paying stock. I still put that in tier three, right? But, something like that that pays regularly, and so reallocate the portfolio. This is a great time to continue to rebalance. Now, you said scarred. They're traumatized, like little T trauma, right? That's not that big T trauma. This is little
Hopefully
T
not.
trauma.
I think
Hopefully
the
not.
operators got some big T trauma, but most of the limited partners have some little T. I think the most I've heard somebody lose that's told me themselves that they lost $300,000 because they had $50,000 across 6 deals and they lost all 6 of them. And I was like, how is that possible? That many of them foreclosed. They were all the same operator.
Operator.
It's that
Yeah.
for one, which just happened to also get foreclosed. So she had 5 with the same operator and then 1 with the other. And I'm like, that what? What? So she lost 300 grand and that's going to set them back a decade or more. And I just, it feels terrible. But for the most part, most of us lost like 50 grand on one, 25 on another. And then the other one paid us back our original investment. So we didn't lose any money, but we broke even. Like most of us are dealing with a little T trauma, like you said. And
Yeah.
you're acting like that was just this massive financial blow, which just, at least for me, it just wasn't.
So, I mean, I want to be empathy first, right? Like, it doesn't matter.
It still
It
sucked.
affects.
I still
It
cried.
right? I mean, I remember I lost my first 100,000 to a Ponzi scheme.
Yeah.
Actually, it was embezzlement. It wasn't a Ponzi scheme. The guy brought on a partner, and the partner embezzled the money
Oh,
And I I was like, I have to walk out and tell my husband
yes.
that 100K is gone. And I mean, and then also like it's something that it's a story that I share with my investors. Like it's not a matter of if something will happen, it's a matter of when. It
Yep.
happens in the stock market. Hopefully that's, a little again, the diversification helps you, but it's going to happen, and that's, where I never encourage any investor, don't give me any money that like don't over allocate to a particular operator. It is worth it for you to take that money if you have like a limit of like say 10% or 15% with any one operator, that's where you have to stick to your investor thesis. Stick to it. You made that decision with a cool head. Let's not get overexcited by the deal that now is in front of you. And you have like, you're trying to make an investment like in the heat of the moment. Like stick to that rule because that rule will protect you. It
Mhm.
sucks to lose 10%, but that rule will protect you. Like you
Yeah.
can recover from a 10% loss. It's harder to recover from a 30% loss or a 50% loss in a
Yeah.
portfolio.
Yeah.
Now, where was I going that with that? Like kind of the big T, little T trauma. We
Just
kind of
kind of
went
like
down a
how to
rabbit
get
hole
back
there.
into the game. Because
Yeah.
the sitting out is going to cost you the most money. So how do you get back into the game from a psychological standpoint? Because you know there's an opportunity cost of you licking your wounds, right?
Mhm.
You know that there's an opportunity coming up because the same thing you just lost money in is now a new opportunity for you to make your money. But it's just so hard for them to be like, oh, when's the right time, right? And they self doubt. Now they don't know how to analyze a deal. All of that. How do they overcome that? If when education was not didn't prevent them from losing money the first time, and now they've lost their faith and like I'm just going to get more educated. What do they do?
Yeah. Education is a tool, right? Nothing can prevent. So when you're trying to educate yourself, yeah, there are certain things you have to understand what you can control and what you can influence.
Hmm.
Okay. You can control your decisions. You can gather as much information to try to be as comfortable with your decision as possible. Your decision is the only thing you can control, right? Once you write that check, it doesn't even matter if it's the stock market, private investing, or got it sitting in the bank. That money is in somebody else's hands. It's in a banker's hands, it's in an insurance company hands, it's in an operator's hands. And so all you can do is now influence decisions to some degree at that point in time. So we have to understand what we can influence and can control. We have to break those apart. And I think a lot of investors right now, are still struggling with that. They're thinking that, okay, if I go back in and I'm doing all my underwriting, that it has to be perfect and then I will control the outcome. No, we can only control the effort we put into researching the deal. That's it. We cannot control the results. I'm
Hmm.
having the same conversation with my daughter in her climbing competitions. I'm like, you can only control the effort that goes in. You cannot control the outcome. So where does this type of investor start? Right? You've got to build back trust. Trust is the foundation of everything.
Hmm.
And most, it's not necessarily trust in other people, but trust with yourself that you can
Yep.
actually make a good decision because that's the only thing you can control. And so start small, right? A small check into a debt deal. Maybe it's placing an investment in the stock market, right? Maybe it's finally opening up that cash flow life insurance policy, which I don't call an investment, but maybe that's it. Make a decision, start small, keep it liquid, and then test the waters. Prove to yourself that you can actually make a decision to give money to somebody else again that you have vetted, that you've vetted the deal, you vetted the vehicle, and reprove that you can trust yourself with the decision.
Yeah, definitely. Well, I remember when I was in business school, we had to read this book called The Speed of Trust, and it was about the different
Yeah.
layers of trust. I think it was Stephen Covey's son, Stephen
Hmm.
Jr. maybe. Um, anyway, it's talking about like self-trust as the first level, and then you have to go up to trusting other people, institutions, all sorts of different kinds of trust. And the more you can learn to trust, the faster these transactions can go. And we all know the velocity of money means that business can move faster, decisions can be made faster. And it's basically a book about what the parameters are to vet out due diligence to establish trust and protect yourself from getting burned. It's fascinating read. And I don't know if anybody is doing work like that on a similar topic. So if it's something that you're talking about, trust is foundational. There are techniques to learn how to trust and what's important, what's not important. So we're not waffling around in a lot of self-doubt and indecision. Because I see sometimes the most educated investors, they're looking for the perfect deal. They're like, oh, I would never invest in a deal that had these 10 things wrong with it. And they just can't find one, can't find one, can't find one. And I'm like, well, we're going to have to look at where you can relax your standards because you're looking at these in such a micro level. You're so educated and you're so into it. You just can't find anything that doesn't have any warts. And that's just an impossible unicorn dream. And so I find that lack of education leads to self-doubt and spinning around, but also too much education sometimes lead to spinning around and self-doubt. Sometimes the underwriters are the most negative ones on the team, in an active deal. So you don't want to get into that deal killer too much. I don't there's a balance there, I guess, because you want to kill a deal. You don't want to fall in love with a deal. But at the same time, you can kill them too much and then you'll just never do anything. And the outcome on both sides of that spectrum is not doing anything. What do you
Mhm.
say to the person who's just too picky?
Yeah, well, I mean, the pickiness well, I mean, is the pickiness anxiety, or is the pickiness a symptom of just, like, too high of standards, right? And, they could those 2 things can be conflated, but if it's
Yeah.
anxiety, I say listen to it, because the anxiety is trying to tell you something, and it's not trying to tell you, "Don't do the deal,"
Mhm.
necessarily. What it's trying to tell you is that you have not gotten enough information, haven't asked a question, so you actually have everything in front of you so you can make a decision.
Mhm.
Right? So, as somebody who's like, "Oh gosh, I just can't put my finger out on this deal, like, I don't feel like" I'll ask them, like, "Well, what's making you nervous about the deal?" Like, "Well, I don't understand, like, the debt parameter," or, "I vested with the operator before, and, the offering memorandum, just didn't have the full debt profile lined out. They said they would know the terms 3 days before close, and that really made me nervous to write that
Yeah.
check." And I'm like, "Okay, well, great. We can actually deal with that." Okay, from 2 standpoints. Like, one is like, let's talk about like how deals actually get closed. Term sheets generally aren't delivered until like a week or 2 before close. So that
Mhm.
the operator isn't necessarily blowing smoke. But what do you need to ask the operator? But do you need to wait and actually wire the money until after the final debt terms are finalized so you can feel more um that you have more data points in there, so you have the control of the decision? Like,
Mhm.
that's a fair question to ask. So listen to the anxiety. I say it's there to tell you that something's up, but
Mhm.
it shouldn't necessarily be a killer to not invest, right? Anxiety
Yeah.
can be crippling though, I will admit. To the person who's just, like, super picky and, like, they've got their A checkbox, like, you're gonna have to underwrite a lot of deals. A lot of deals. And if you have the bandwidth and the time and attention to do it, I mean, and you're okay with the opportunity cost, maybe,
Yeah.
right? But if you're not okay with that, then we gotta, reorient to again, like what's in your control, what's out, what are the things that you can influence, and let's reorganize that checklist to like what are your must haves, right? The things that you have to have in a deal that you just will not be able to like if a deal has a adjustable rate mortgage, you're just not comfortable with it. Great. Fine. You're not going to look at any you're just not even going to look at any deals that have an
Yeah.
adjustable rate mortgage. Let's pick like 5 variables that just are just complete deal breakers, and then the other ones we kind of have to put them on a grading scale.
Yeah. It's kinda like your tiers that you were talking about with risk management. There should be tiers, for deal selection because that is part of risk management. It's like, how many wards can this thing have before I'm like, "I'm out?" Because there is an opportunity cost that we can calculate. You got money sitting around doing nothing. It's like the person who's the story I always tell a friend of mine, she was shopping for a sewing machine, and it took her months. She kept shopping for the best price sewing machine, and she finally found it, and she ordered it, and she got to her house, and she was so excited, but she kept looking, and she found one that was 89 cents cheaper than the one she bought and was considering sending it. So she was
89 cents?
like, "You know what? Your mental health and the shipping and the hassle are I mean, we gotta talk you off the sledge." And so that is an extreme example of what I'm talking about, but that's what opportunity cost is. It's like not placing your money at a certain point you would have made more in a couple of uh, doubles or second base hits than you would by sitting around waiting for a home run. And everybody's situation is different, and not everybody needs to do that to the cent calculation. Although some people can and they do. It's just one of those things where it's like usually the solution, honestly, is just put in less money. If it's not great, you're not super happy with it, but you're mostly happy with it. You think it has a good chance to be successful, and the minimum is 100,000, and you're like, I'm not. If they won't come down on the minimum, like I'd walk. If it's not feeling comfortable, but you can find something with a low minimum or go to the crowdfund model. It's like throw in $1,000 or something. Just put in less if it's pretty good but not perfect. If it's second base or third base, just do it, right? And get your money out there working. That's diversification, and there's a management headache there when you have too many deals, but you can kind of sort that out over time where you're comfortable because over diversification is kind of a scarcity mindset as well. So
Yeah.
there's just a lot of mental stuff here. Behavioral finance is so fascinating, isn't it?
It is. Well, and like, how do you know hit that like too many deal mark? It's like when you don't
Mhm.
want to pay your tax prep deal because you're
Yeah.
you got too many K1s. If you're just like, wow, okay, I've jumped up from 3,000 to 5,000 or 5,000 to $7,000 tax prep. Like, okay,
Yes.
like now I know that I gotta reorg like how many
Yeah.
K1s I'm gonna have.
That's a good point too, because the more deals you have, how much more can you afford in tax prep before it just ate up the returns on doing 30 deals? There I did talk to an investor years ago when I very first started out that he had lost several $1,000,000 in a deal, and he now had a rule he wouldn't put more than $50,000 with one operator twice. So $100,000 per operator, but had to be in two deals. And boy, underwriting stuff was a part-time job for him. He was older, retired, and I was just like, this is this doesn't sound fun to be this scared and to be this hyper diversified, unless you really like it. I have met another guy, he's like, "I just really like it." I'm like, "Great," but the other guy didn't like it, but he was too scared to change his parameters. So, just that so there's a lot of introspection there that, educators like you can help people kinda work through because these are questions that everybody has to ask. So, um,
Well,
tell
can
me
I stack on
Oh,
can I
yes,
stack one
please.
thing on top of that?
Yeah,
Well, okay, where's your biggest risk gonna occur? It's when you're first starting out, right?
true.
So there is an immense, I was talking to an investor the other day, and it was their first deal, and they were like, "I have $300,000 to invest," and I'm like, "Okay, let's do
Calm
25 to
down.
50K in the first deal." And I was like, because this is your first deal, you're just starting off. Like, one, there's a lot of things that you have to prove to yourself. Let's get you into a deal that you can make. You made a confident decision, so we can get some momentum. And I was like, but you know, long story short, your concentration risk is really at the very beginning when you first start investing.
Yeah.
So don't so while at the same time, if somebody, has been in the game long enough, they should, in theory, should write larger checks, to for scale of efficiency. At the
Mhm.
same time, if you're just starting off, I would keep it minimum for a reason, so you can. If you have $300,000, let's get you in 6 deals at 50K,
Mhm.
so
With
you get
not
some.
not the same operator.
Not a lot of other portfolio questions. I'm
Spread
just
it
gonna
around.
go there.
Spread it
Yeah.
around. Yeah. And maybe not all real estate. Like these diversification tactics are what covers the lack of education. Because what did Warren Buffett say? Like the more you know, the less risk you take. But that the real wealth is made in concentration. And so these kinds of things, it's like the more you know, the less risk you take, the more you can concentrate. So and the diversification is like, for idiots who want mediocre results. I think Charlie Munger said something like that. And so these are just all questions everybody has to ask because when you get to the preservation of capital mode to your investing, like you don't care what Charlie Munger says about diversification is for idiots looking for mediocre returns. I'm like, I'd be super happy with mediocre returns at this point. So, but you kind of had this journey along for the last couple of decades, as you won your stripes and become a passive investor and getting to the point where you feel like maybe I don't have to work anymore, right? I want to talk about two things. One, cash flow because I think what most people realize when they have enough net worth invested that they haven't really taken care of cash flow management. I certainly have fallen into that trap. We hear that, what is it, asset rich, cash poor. So let's talk about just briefly the cash flow management of living on passive income. And you mentioned it with private debt. I want to see if you have that and other ideas. How to take care of that cash flow and then still working. So finding something that you're really passionate about, finding a value that you can bring to the marketplace, because that active income could also help smooth that cash flow gap as well as bring a sense of fulfillment. So you can tell me about what your life kind of is looking like right now or where it's going over the next 5-ish years with cash flow management and fulfilling work.
Yeah. Well, so I'll start with the cash flow management. So for me, I started kind of landing on that like tier one, tier two, or three breakdown. Like,
Right.
about 2019, we started to see, interest rates, cap rates compress.
Hmm.
Interest rates were going up. It was going to be harder and harder and harder to get a multifamily deal to cash flow. Self
Hmm.
storage wasn't that far behind. Um, so I was like, that was my first kind of like ding, ding, ding. Like, okay, I won. Are any of my current deals going to get affected? The answer to that was probably.
Yeah.
Um, so I was like, I need to start preparing with cash flow in my portfolio now in case that happens. Okay.
Yeah.
And then two, I was like, if cap rates are compressing, and interest rates are going up, and mind you, I did not have a crystal ball. I am not like a genius here. I was just, paying attention to like signals on the market personally. I was like, then am I going to be able to find, if my deals start exiting, am I going to be able to find a suitable replacement? If it's cash flowing
Yeah.
8% right now, what's my replacement going to be? 3%? I'm like, I
Mhm.
don't whoa, I need to find deals, bring on a different asset class that is pretty stable in its cash flow return. And that's where I landed on the fix and flip debt. Because those type of investors, I used to be one, right?
Yeah.
I did 42 of these deals. Um, and that's just not my flips. Those were just the rentals that I held. I was
Yeah.
like, what do I want? I want speed and customer service. If I can control costs, great. But like whoever can put, 100K in my hand so I could close in 3 days, they won my business, right?
Yeah.
So they're pretty price insensitive. And so that's kind of where I landed. I understood the market. It was something I invested in, or a tool that I had used. So I was like, yeah, it might move by a percentage point, but not like my cash flow won't drop in half.
Mhm.
Right. So those are the type of things that I started adding to my portfolio. The past couple of years, I've added a little bit more dividend stocks. I don't
Yep.
really like the stock market,
There's
but I've been playing around with the dividend stocks and stuff. Probably a little bit more than I should. So that was how I started solving for the cash flow piece, was making sure that I had enough income coming in through those what I call the tier two investments, tier one and tier two investments, to be able to, really sustain me. That, it pays for the mortgage and put the food on the table and all, my
Mhm.
utilities and stuff like that. Am I going to go to Europe on that? Probably not. I got to build that up. Um, So, but I'm still trying to balance that with some of my more tier three equity investing.
Yes.
As far as what I'm doing in the next 5 years, I have a teenager
Yes.
who goes to high school, so next year. So, anyways, we're playing that game, but we're just trying to spend, time as a family and travel, you and my cash flow, my investing allow me to do that. And so I hit an inflection point in 2021 where I had enough cash flow coming in. I knew I was still repositioning my portfolio. And I'm like, how many more active general partnership deals do I have to add to my portfolio
Uh,
to make this all work? And I was like, none, really.
No. The winner.
Cool. That's when, we were at with the private equity firm that I was at that point in time, we're at an inflection point with like, how's the business pivoting? And, for me, I was like, okay, you know what? I'm not retired, but I have enough cash flow to step back and really like evaluate. I was like, I'm going to just enjoy my family for the next 6 months to a year. I'm going to figure out what's next for me. My dream job landed in my lap 2 weeks later.
Oh boy. Yeah.
So yeah, people are like, you're not unemployed. Yeah, you're right. I'm not, because I love what I do. Like when I wake up in the middle of the night, I'm solving problems for my investors. Like,
Hmm.
and I like it. Like,
Yeah.
kind of a nut for it. And so that's all that I really want people to be able to have in their life. When we talk about enough and fulfillment, is like, what would you wake up and do every single day if you like, you know, got paid $10 an hour for?
Yeah.
Everybody says if you didn't get paid. I'm like, well, if you didn't get paid, you
What
want to
did you
do
want?
something. You want to show up. But like, you got paid minimum wage for, right? You know?
Yeah. Yeah. I mean, we did the same thing. Like we last summer, I asked my husband, I'm like, we're having a cash flow crunch. Should we work? Like, do we need to sell a rental? Like we've been working on smoothing this out for several years. And he was just so over IT. Um, and he had interviewed for a couple of positions with a recruiter. He's like, I don't want to do this. There's no part-time IT. And plus I'm obsolete. I don't really want to get caught up. I don't like doing this. And there's no amount of money that would get me to go do this because, you're just not desperate at that point. You're not hungry. And so you're not willing to do that hustle anymore. And one day he goes, I just want to do something really easy and low stress, like drive a bus in Alaska. And because his little brother used to drive a bus back in college, like a college summer job, and he's always talked about how great it was. So he calls up his brother and he goes, I just want to drive a bus in Alaska. I'm like, oh, he's serious. Like we went out and did some adventures. We traveled full time. We hiked across Arizona. We RV'd across the country for almost a year. And I was like, well, I guess it's his turn to choose something crazy. So he basically went and worked for like $30 an hour, driving tourists around, telling them how great Alaska was. Well, we all got to live in Alaska for 6 months and enjoy and kind of work alongside him. My daughter was working there. I was working there. It was like this incredible type of experience when you ask yourself, like, what would I do for $30 an hour? It's not, IT. It's not the stress of running another apartment building. It was like being a tour guide in Alaska. And your life starts to change from that standpoint. And I feel like that was kind of like when he was working a W-2 and I had like a little mom hustle so
Hmm.
that could supplement his income with some lifestyle stuff. That's what I feel like we're doing right now. We've got our W-2 as our passive income, but then we're supplementing our lifestyle with some hustle stuff that's super easy, low stress. And I'm taking a break for the next 6 months, maybe a year to figure out what comes next for me. It's just such a wonderful place to be. There's no private jet. There's none of that. But at the same time, it's like the peace and the
Hmm.
time thing. It sounds like you had when you have the opportunity to do that, a similar experience. You never know what's going to come out of it.
No, oh no, it gives you space. And I got, I do a lot of coaching, my book, Money for Tomorrow, like,
Yeah.
one of the, personal finance, like one of the things is like keeping up with the Joneses. Like, do you want the personal jet? Does that even, some people do. Some people want the personal jet. They want the fancy clothes. They want to,
Complication.
have the luxury travel and the private islands. To you, you're
Yeah.
going to have to do something to scale that net worth.
Hmm.
Um, you're going to have to stay active, for longer, or, hit it big in order to get that. But if you're willing to work and do that, more power to you,
Hmm. If that
uh,
motivates you, use it. Like
yeah.
whatever the thing is that motivates you. For me, all owning that stuff or managing that stuff is a complication that I don't want to have. It's not just to get to that point, but then it's to maintain it once you get there. The staff, the expenses, like I always told my husband I wanted to own horses. Let's buy some land and get some horses. And we bought some land and we started renting land to somebody else to put their horses there. And I was like, I don't like this. Could we just go ride somebody else's horses? So we went and got like lessons and we could ride the same horse every single time. It was like being a horse grandma. I'm like, this is amazing. It's like renting horses. There is a cost of ownership, both financial and time wise and then emotionally. So, but whatever it is that motivates you, harness that and go for it. So it takes, again, we're back to the behavioral finance. You have to dig in and learn
You have to
what
give space. And I think a lot of people are scared to sit in that tension. to
Yeah.
really
It's
understand what they want. I mean, we're all busy. Like, um, I had one coaching client, you know, she's trying to kind of figure out the next phase of life. And I would be like, okay, here's the exercise. And she like did the exercise. Yes, the video was 5 minutes long. It was one page to fill out. Emailed it back to me in 15 minutes and goes, I'm done. I'm like, no way.
ugh.
No way are you done. And I just kept pushing it back to her and like asking questions and digging in deeper. And then finally she was like, oh no, you're serious. You want me to actually like think into this? And I'm like, yeah, give yourself space. Go on a hike. Hey, take a 3-day weekend. Like that's only you. And just think like what, if you could paint this beautiful picture, what would look like. And for me, whenever I sat and actually really started, I called it wrestling with the question of enough. I was like, 95% of what I want is already, like, right here.
Yes. Yeah. Yes. S oh,
But a
boy.
little bit more cash flow, help me out with that? Yeah, like, a little bit more stability in my portfolio? Absolutely. But it was I had, and it was colliding with COVID, like, we were able to travel, our child was out of school, we had all this flexibility, I was like, "That's the full life that I want." Like, how
Yeah.
do I create this on a daily basis?
Yeah. Oh, yeah. I mean, the same thing. We were homeschooling when COVID hit already, and I was like, "This is the best thing that's ever happened to me," because you have that I've been grappling that for, like, the last 2.5 years, and haven't really come up with any good answers of what's next. I've dabbled with a few things, and I'm really head on it. It takes a long time, and it is very uncomfortable, like you said, to sit in that tension, but I'm telling y'all listening, like, you wanna have these problems. Like, I hired a performance coach a couple of years ago to try and help me through this, and he would say, "Wow, you've really upgraded your problems since we started working together." It's like, "You have a much higher level of problem now." And problems are never gonna go away. They're never gonna go away, but you're upgrading your problems, and the way that you get to this point where you have these kinds of first world whiny problems, let's call 'em, it's that
Yeah,
journey of
that's exactly what they
self-improvement.
are.
We're higher on Maslow's hierarchy of needs, and it's a privilege to be up there, so if you wanna get up there, this is the kind of stuff we're talking about, like, passive investing is what gives you the space and the cash flow to be able to just stop and think, "What do I wanna do next?" Whether it's a hustle to smooth cash flow, or maybe you have enough that you really can just volunteer full time. Whatever it is, this is where you wanna get to. And what Whitney and I have done is get us to this point where we can have these kinds of conversations with ourselves that can take a whole weekend or 2.5 years. I'm still struggling with it. And I feel like that's what I want the show to bring to people, and that's what you do as a passive investing educator, is to help people get onto the road, guide them through it, and get them to where they're now struggling with the kinds of things that we're struggling with. It is it sucks, but it's fantastic at the same time. So I appreciate you sharing your journey with our listeners, and people can reach out to you at passiveinvesting.com up there on the screen, and watch your YouTube channel. And then where do they buy your book at? I mean, I'm assuming Amazon, but
Yeah, Amazon's the best place. Just check it out there, leave a review.
all right,
That helps it
money
reach more people.
money for tomorrow. And this is just step by step of how we're getting from where we were to the kinds of wonderfully high level problems that we're dealing with now. So check it out. Reach out to Whitney. Reach out to me at investwithemma.com. Same kind of thing. You want to talk about any of this stuff? I'm not raising money for anything. I don't have a job. Like, I just love talking to people because I felt like the only people educating me about passive investing when I first started were the people who were wanting to raise money from me. And so I had to have kind of a mindset of, I don't have to put money there. I don't have to reciprocate. I can just enjoy the education. And if it's a good fit, I'll invest. If it's not, I don't have to invest. So it was very difficult for me to engage with capital raisers for that education because it invokes that reciprocity. And so it's actually kind of a nice place for me to be right now where I can just say, I want to educate people and just because I feel like it. So definitely encourage you to reach out to Whitney or to me at investwithemma.com and just let us help you figure out how to pay for your life's adventures by using passive income. That's what we're here for. So thanks for joining us, Whitney.
Oh, and thank you so much for having me on it,
All
Emma.
right. And I'll see everybody next week when we talk about our next passive income adventure.